So we mentioned short selling last week when Chris talked about what happened with GameStop, but we didn't go into detail about what it is. So that's what we're going to do today. So first of all, let's start with going long. So this is the term that we use to refer to the type of investing that we're talking about here, right? So we want to buy a stock when it's, or buy shares in a company when it's trading low, so somewhere down here. And later, we're going to sell it for more at a higher price, okay? And the profit we make is in the price that the share moves up, okay? Now, that's pretty straightforward. That's something that most people understand. But short selling is the opposite, okay? So we're still going to try and sell high, and then we're going to buy low, but the order is reversed. So instead of buying first and selling second, we're going to sell first and buy second. And again, the difference in the share price is when we make the profit. But instead of profiting when the share goes up, like we do with long, we profit when the share goes down. Now, this might not make sense. So we're going to look at how this works, okay? So how do you, for example, sell a share that you don't own? Well, let's start with the broker. So everyone to trade shares has a broker, okay? And they hold the shares on your behalf. Now, if I want to short a stock, I go to my broker and I say, okay, I'd like to short 10 shares of Tesla, for example. My broker says, okay, no worries. They go and take a look at who else they have on their books, and they see that Chris owns 10 shares of Tesla. And they go, okay, you can borrow Chris's shares and sell them to the market, okay? So that's exactly what happens. I take the borrowed shares and I sell them on the stock market, and I collect some money for that. Over time, the stock price goes down, and I decide that it's gone down enough. I think maybe it's going up, or I don't know what's going to happen with it, and I need to return the shares that I borrowed. So I buy back the shares. That's where I've made my profit. The price has gone down, I've sold, I bought, I make a profit. And the final step is I give those shares back to my broker, and my broker gives them back to Chris's account, okay? With him none the wiser. I'm going to walk through here an example of a short selling process because with actual numbers, because it can be a bit simpler to see that way. So we start with borrowing 1,000 shares, okay? So I'm left with, I've got no money, but I've got 1,000 shares that I borrowed from my broker. I next sell those shares short. Let's say they're trading at £10 per share. So I sell 1,000 shares at £10 and I collect £10,000 in my account, and I've got no shares. Now I sit there. Price moves up and down, and over time it's declining. Nothing is happening with me. I've still got £10,000 in my account and no shares in my account. Eventually I decide to close my position, and I'm going to buy back the shares. So let's say that they're trading now at £5. Now remember, I sold them at 10 and I'm buying them back at £5, which means I have to spend £5,000 to buy them all back. That leaves me with £5,000 left of my initial sale money, and I've got now 1,000 shares. The final stage is to return those 1,000 shares to my broker, who's going to give them back to whoever I borrowed them from. And realistically, it's not borrowing them from one person, it's just borrowing them from their whole books, but that's all right. Once I've returned them, I'm left with the £5,000 profit between the sale and the purchase, and no shares. And that's the whole process. Now, short selling is good. It has some advantages, and one of them is that it allows us to make profit when shares are moving downwards, which is not something that we can do with going long. But they have a risk. Now, if we go long, we can make infinite money on any share, right? If we buy a share at £10, it can go up to 100, or it can go up to 1,000, or it can go up to 10,000. And that is all profit that we can make. Our maximum loss is the value of the share. You know, we bought at £10, it can go to zero and no lower. You can't have a negative share. And that's the £10 we would lose per share. That's straightforward. Now, the reverse is true for going short, right? When you're going short, you make money if it goes down, and you lose money if it goes up. It's got a capped amount that it can go down, right? It can go from £10 to zero, and that's the max we can make per share. But shares can still go infinitely high, and you can keep losing money as it goes up. So instead of gaining money per share, you can lose £100 per share, or lose 1,000, or lose 10,000, however much it might be. So that's why most brokers won't let you go short unless they can be sure that you know what you're doing, because it's inherently riskier than going long. So why do people do it? Well, there's one main advantage to shorting, and that's what's known as leverage. Leverage is when you can use smaller amounts of money to make more money. So it's quite common with a lot of other instruments. We're going to move on to talking about options and futures in a future date, and they're also leveraged products, but short selling is the most basic of them. Now, leverage is most easily explained with an example, so we're going to jump straight to that. If we go long, we talked about the 10 shares at £1,000, 1,000 shares at £10, sorry, right? Let's use that same example. Let's say we want to buy 1,000 shares at £10. That's going to cost us £10,000. Now, let's look at the two ways this could go. First of all, the share price could move up to £15, in which case we've gained £5,000, right? A 50% gain of our initial money. Or it could drop £5 a share down to £5, and we lose £5,000. So that's also a 50% loss, right? Now, let's look at the same example, but going short. Now, when you go short, you use what's called margin, which we're going to talk about in a minute. But it essentially means that you don't need to have all the money that the trade is worth. Okay, because remember, we're borrowing shares, we're not buying shares, so we don't have to use money. We gain money from this. So, say we have some initial money of £5,000, we could probably still short sell that same 1,000 shares, but for a cheaper amount of money. And now maybe it drops to £5, and we gain that £5,000. And that's 100% gain on our initial money, which means it's a much better way of making money. It does it quicker. But the same is true if we lose money. So if it goes up to £15, that's a 100% loss of our money, right? That's our max loss that we can cover. So twice the gain, double the loss. Pretty straightforward. This brings us back to margin. Okay, so I talked about here, you'd only have to put in £5,000 instead of 10,000. Well, what did I mean there? Well, your broker needs to know that you can cover your losses. Okay, so if we're selling 1,000 shares at £10, they might have a margin percentage of 50%, which means we have to have £5,000 of cash in our account already to cover this investment. What that means is we've got £5,000 of potential loss already covered. So in this example, where the price is going up against us, the broker's not worried, because if we have to buy back our shares, they know there's enough cash in the account that we can do it. So they're not going to take a loss on it. But if the price goes over £15, well, now we don't have enough cash to buy it all back. So the broker is going to perform what's called a margin call, which is where they demand more money from your account to cover the potential loss. If you can't put that money up, you're going to have to buy back your shares immediately and cover the difference. Or you can put up more collateral, more money, and they'll allow you to stay in the position. So this is one of the major downsides to short selling, is that you might have what's known as a margin call, and that's quite a difficult thing to deal with at times. Other things to consider about short selling, these are all things that reduce the power of leverage, right? So we talked about the one advantage of short selling is its leverage. These are some of the downsides. So there's the first one is the unlimited risk to the upside. If the share goes up, you can just keep losing more and more money. Shares often pay what are known as dividends. We're going to talk about those at a later date, but you owe those to the people you borrowed the shares from. You also pay interest on the shares that you've borrowed. Otherwise no one would lend you their shares. And at any point, the broker can recall your shares. Now, they probably won't do that unless you get a margin call, but theoretically they can, and that's another downside. There's also the possibility of a short squeeze, but that's something to go into at a later date.